Groww, Lenskart, Swiggy, these are a few big names which went for IPO in the last 12 months. Billions of dollars were raised. Thousands of crores flowed from investors to companies. But behind each of these IPOs, investment bankers made 100 to 200 crores in fees without putting in a single rupee of their own money. Welcome to the world of investment bankers, the industry which literally runs the world. Today, we will understand what investment bankers actually do, how they make these massive deals happen, and why companies pay them so much. Investment bankers don't actually invest in anything, nor are they bankers in the traditional sense. Investment bankers are professional deal makers instead. The bridge between the companies that need money and the investors who have money. You know how marriage bureaus work in India? They find the perfect match between two families. They understand what each side wants, negotiate terms, handle all the formalities, and ensure the alliance proceeds smoothly. And then they take their fees. Investment bankers do exactly that, but instead of matching families, they match companies with billions of rupees and they charge crores in fees for it. Investment bankers connect them, structure the deal, navigate all the complexities, and make sure the money actually flows. That's their core job. So, investment bankers work on three major types of deals. Let's break them down one by one. Deal type number one, IPOs, taking companies public. This is exactly what happened with Groww, Lenskart, and Swiggy. Suppose you and your friends started a cloud kitchen. It became famous and super successful. But now you want to open 20 kitchens across India and you need 100 crore rupees for that. To do that, you have two options. A, you find one super rich investor to give you all the money needed. Or you can take the company public and let thousands of regular people buy small pieces of your company through the stock market. The second option is what we call an IPO. For Swiggy's IPO, which raised thousands of crores, investment banks walked away with 150 to 200 crores just for orchestrating the entire process. Deal type number two, mergers and acquisitions, also known as M&As. A merger is the merging of two or more companies, usually of similar size, to form a new single entity. An acquisition, on the other hand, is when one company, which is usually a bigger one, buys another small company. Think of Tata buying Air India, or think of Walmart acquiring Flipkart for $16 billion. Now, buying a company isn't like buying a car. It's more complex than you think. There are questions that need answers. For example, is this company actually worth 10,000 crores? Are there any hidden debts in this company? Are there any pending lawsuits against the company? Will this deal make strategic sense in 5 years or 10 years? Investment bankers figure the answers to all such questions, acting like a combination of detectives, accountants, and negotiators. They analyze financial statements, research the industry, calculate a fair price, structure the payment process, and manage months of negotiations between two sides. In an acquisition of 5,000 crore rupees, investment banks typically charge 1 to 2% in fees. That's 50 to 100 crore rupees for a few months of work. Deal type number three, raising capital for growth. Sometimes companies don't want to go public or get acquired. They just need money to expand, maybe to open new factories, launch new products, or enter international markets. Investment bankers help them raise this type of capital in two ways. First, debt. It is like taking out a massive loan. The company borrows 500 crore rupees from banks or financial institutions and repays with interest over time. Investment bankers find the right lenders, negotiate interest rates, and structure all the terms. It's like getting a home loan, but for 500 crore rupees instead. The second way is equity, which means selling a stake of the company to investors for cash. You've seen Shark Tank or Shark Tank India, right? Entrepreneurs give 20% equity for 2 crore rupees. Now, investment bankers do this at a corporate scale, helping raise 300 crore rupees, for example, by selling 15% equity to private equity funds. Now, you might be thinking, all this sounds interesting, but what do I need to do to become an investment banker? The truth is, you don't need to be a finance genius. What matters is your ability to learn quickly, work under pressure, and pay extreme attention to detail. The core skills required are financial modeling, analytical thinking, communication, and attention to detail. One mistake in a financial model can cost millions. One error in a legal document can kill a billion-rupee deal. Precision is non-negotiable. Most people usually start as an investment banking analyst with a starting salary of 12 to 15 lakh rupees. After 2 to 3 years of solid work, you become an associate, earning 18 to 25 lakh rupees per annum. And after 4 to 5 years, you can become a vice president, earning 30 to 50 lakh rupees per annum. You see how financially great investment banking as a career is? Now, if you're a college student or graduate watching this video and this career excites you, here's the most important thing you need to know. There are many ways to break into investment banking, but one stands head and shoulders above the rest, and that is the CFA certification. The CFA certification is globally recognized as the gold standard in investment and finance. It's what top investment banks, private equity firms, and hedge funds look for when they're hiring. And here's the best part. With Imarticus Learning, you don't just prepare for CFA, you get industry-aligned training from KPMG in India. That means you're learning from industry experts, getting real-world insights, and building the exact skills that investment banks demand. Don't wait. Click the link in the description below, explore the CFA certification program, and connect with our expert counselors to begin your journey into this high-paying investment banking industry.